Welcome to the complete guide on mastering the 4% rule. If you're serious about building wealth and achieving financial independence, you need to understand this one principle that could change your entire financial future. Before we dive in, if you find this breakdown helpful, please subscribe to the channel so you don't miss our next guide on practical wealth building strategies. The 4% rule is deceptively simple, yet it's the foundation that millions of people use to plan their retirement and passive income streams. Let's break down exactly what it means and how you can apply it to your own life right now. At its core, the 4% rule states this: if you withdraw 4% of your investment portfolio in the first year of retirement and then adjust that amount for inflation in subsequent years, there's a very high probability your money will last through a 30-year retirement. This principle emerged from historical research dating back decades, and it's grounded in real data about market returns and inflation patterns. The rule assumes you have a diversified portfolio, typically split between stocks and bonds, and that you're willing to stay disciplined with your withdrawals even when markets fluctuate dramatically. Why exactly 4%? The answer lies in something called the safe withdrawal rate. Researchers analyzed historical market data spanning nearly a century and found that portfolios surviving through multiple market cycles and recessions could safely sustain withdrawals at this rate. If you withdraw more than 4% annually, you dramatically increase the risk of running out of money before you die. If you withdraw less, you're being unnecessarily conservative and leaving substantial wealth on the table. Let's make this concrete with real numbers. Suppose you have saved $1 million for retirement. 4% of $1 million is $40,000. This means you can withdraw $40,000 in your first retirement year. The following year, if inflation has been 3%, you would withdraw $40,120. You continue this pattern for the rest of your life, and statistically speaking, your portfolio should sustain you through decades of retirement. This transforms the abstract concept of retirement savings into an actual spending plan you can live by. The beauty of the 4% rule is that it removes emotion from financial decisions. Instead of wondering whether you can afford a vacation or a new car, you know exactly how much you can spend each month based on your portfolio size. This clarity is incredibly powerful. You're no longer stressed about whether your money will last, because the mathematics has already answered that question with a high degree of confidence. But understanding the rule is one thing, and actually mastering it requires deeper insight. First, you need to acknowledge that the 4% rule assumes a balanced portfolio. That typically means something like 60% stocks and 40% bonds, though the exact allocation can vary based on your age and risk tolerance. A portfolio that's 100% stocks might technically support a higher withdrawal rate, but it introduces far more volatility and risk. Similarly, a portfolio that's 100% bonds might require a lower withdrawal rate because bond returns are typically more modest. Second, you need to understand inflation's role in this equation. The 4% rule already accounts for inflation by design. You're not withdrawing 4% every single year from the original portfolio value. Instead, you're withdrawing 4% in year one, then increasing that withdrawal by the inflation rate each subsequent year. This is called inflation adjustment, and it's absolutely critical to the rule's success. Without this adjustment, your purchasing power would gradually erode, and your lifestyle would diminish even though you're spending the same dollar amount each year. Third, consider the concept of sequence of returns risk. This is the danger that bad market returns early in your retirement could jeopardize your long-term financial security. Imagine you retire with $1 million and immediately encounter 3 years of terrible stock market performance. Your portfolio shrinks to $800,000, but you're still withdrawing $40,000 annually. This accelerates your portfolio's depletion. The 4% rule assumes average market returns over the long term, but individual years vary wildly. Being aware of this risk helps you make smarter decisions during market downturns, like temporarily reducing spending or picking up part-time work. Now let's talk about how to actually calculate your retirement number using the 4% rule. The math is remarkably simple. Take the annual spending you'll need in retirement and multiply it by 25. That's your target number. If you need $50,000 per year, you need $1.25 million saved. If you need $80,000 per year, you need $2 million. This 25 multiplier is simply the inverse of the 4% rule. 4% of 25 equals 1, which represents your full annual spending amount. This framework transforms retirement planning from something vague and intimidating into something concrete and achievable. Instead of thinking about saving millions without understanding the end goal, you can calculate exactly what you need based on your lifestyle preferences. Want to spend $40,000 annually? Save $1 million. Want to spend $100,000 annually? Save $2.5 million. The relationship is linear and transparent. Let's explore some practical applications. Consider someone who currently spends $60,000 per year. Using the 4% rule, they need $1.5 million to retire comfortably. If they're currently saving $20,000 per year through their salary and investments, they can calculate exactly how many years until they reach financial independence. This becomes incredibly motivating because you're not just saving with vague hopes. You're working toward a specific, calculable goal with a clear timeline. The 4% rule also helps you understand the trade-off between working longer and living more frugally now. If you could reduce your annual spending by $10,000, you'd only need to save $1.25 million instead of $1.5 million. Alternatively, if you could earn an extra $5,000 per year from side income, you'd reach your number 5 years faster. These insights help you make informed decisions about your priorities. However, the 4% rule isn't perfect, and you need to understand its limitations. First, it's based on historical data, and past performance doesn't guarantee future results. If future market returns are lower than historical averages, the rule might be overly optimistic. Conversely, if returns are higher, you could safely withdraw more. Second, the rule assumes a 30-year retirement. If you expect to live significantly longer, you might want to use a 3% withdrawal rate for added safety. If your retirement will be shorter, a 4.5 or 5% rate might be reasonable. Third, the rule doesn't account for major life changes, like serious illness requiring extensive medical care, or supporting adult children or parents. It's a framework, not a guarantee. You need to build flexibility into your financial plan. Some people use what's called a guardrails approach, where they set upper and lower spending limits. If their portfolio grows significantly above projections, they can increase their spending. If it shrinks below a certain threshold, they reduce spending temporarily. This adaptive strategy maintains the benefits of the 4% rule while acknowledging real-world uncertainty. Let's talk about how to implement the 4% rule in your actual portfolio. Start by determining your target annual spending in retirement. Be realistic and detailed. Consider housing, food, transportation, healthcare, entertainment, travel, and any other expenses you anticipate. Add a buffer for unexpected costs. Once you have that number, multiply by 25 to get your target portfolio size. Next, commit to a diversified investment strategy. Open accounts like a 401k, IRA, or taxable brokerage account, depending on your situation. Invest in a mix of index funds tracking stocks and bonds. The specific allocation depends on your age and risk tolerance. A common approach is to subtract your age from 100 and use that as your stock percentage. If you're 40, that's 60% stocks and 40% bonds. As you age, the percentage of bonds increases, reducing volatility. However, this is just a guideline. Some people prefer different allocations based on their circumstances. The key is to choose an allocation you can stick with through market cycles without panic selling. Once you're retired and living off your portfolio, discipline becomes paramount. Withdraw exactly 4% in year 1, nothing more, nothing less. In year 2, increase your withdrawal by the inflation rate. In year 3, do the same. Don't try to time the market or make adjustments based on what you think will happen next. The rule works because of its mechanical consistency. If you abandon the rule whenever the market looks scary or opportunities seem attractive, you lose its protective benefits. That said, there's room for intelligent adjustments. You could increase your spending somewhat. If it's shrunk below expectations, consider reducing spending temporarily until it recovers. These adjustments should be thoughtful and based on actual data, not emotions. Some financial advisors recommend an annual review where you assess your portfolio performance and adjust if necessary, but changes should be gradual and measured. The 4% rule also helps you think about the relationship between your career earnings and your financial independence goals. Every dollar you earn and save is a potential withdrawal in retirement. If you invest $20,000 today and it grows over decades, that investment might generate $800 in annual retirement income using the 4% rule. Understanding this relationship can be motivating. Your career isn't just about today's paycheck. It's about funding your future freedom. Consider also how inflation affects your calculation. If you're planning retirement 30 years in the future, inflation will have eroded purchasing power significantly.